Hi, this is Sean Perkins, financial strategist and faculty advisor with the National Institute of Financial Education. And I'd like to talk to you today about how waiting to purchase a home may cost you thousands of dollars you haven't even considered. This is an excerpt from a home buyer education seminar I do called Buying a Home in Today's Market, A Path to Home Ownership. There are many reasons why people wait to purchase a home, but the top 4 reasons are as follows: saving for a down payment, waiting for home values to drop, waiting for interest rates to drop, and waiting to fix a credit issue of some kind. There are many more reasons why people wait, but these are the more common reasons why, and what most people don't realize is that waiting can cost a lot of money. The most significant way that waiting can cost you a lot of money is when lending guidelines change. When the housing crisis hit in August of 2007, lenders tightened their lending guidelines significantly, making it much more difficult for home buyers to qualify for mortgages. Some of the ways they did this were by requiring higher credit scores to obtain financing. At one time, you could buy a home with a 570 credit score, and then it went to 600, 620, and now we're at about 640, and possibly on our way to 660. Another way that lending guidelines tightened was a reduction to the debt-to-income ratios allowed by lenders. What that means is that the amount of your debt, your mortgage payment, your car payments, credit card payments, as a percentage of your income has decreased. You used to be able to have, say, 50 or 55% of your income obligated to debts, and now it's down to 45 and probably on its way to 40 not too far from now. They started reducing loan to values. What that means is the loan against the value of the property has gone down, thus requiring a bigger down payment. It used to be you could buy a home with 0 down. You can still do that with a VA loan. FHA is at 3.5%. Conventional used to be at 0 or 3%. Now is at 5 to 10%. So larger down payments are being required in some loan programs. Another way would be the lack of availability of mortgage insurance. When you have less than a 20% down payment, lenders require mortgage insurance of some kind, and since mortgage insurance companies took the biggest hit to their books when loans went belly up, they've stopped offering mortgage insurance, or they only do it for the upper 1% of people with higher credit scores and low debt-to-income ratios. So mortgage insurance is very hard to come by. Some lenders are requiring a lot more money in reserves. This would be money left over after you purchase the home. Could be 2 to 6 months worth of your mortgage payment left in a savings account of some kind, just to be sure that you can handle the higher mortgage payment than maybe what you were paying in the way of rent. And lastly, they might be disallowing gifts or seller credits. It's not uncommon in any market, really, to have a seller credit the buyer an amount of money they can use to pay for closing costs, so that the buyer ultimately only has to come up with a down payment. That may very well go away. It's already being looked at as being reduced from what it was, and it could go away entirely. Also, disallowing of gifts. It's not uncommon in a government loan, VA or FHA loan, to receive a gift from a family member of some kind to use towards the purchase of a home, and that may very well be going away, and that could affect a lot of people who don't have enough money to buy a home. Another thing that can happen that can cost you money, obviously, is interest rates can go up. And interest rates are obviously volatile, up and down all the time. But right now we're on a bit of an upward trend, just having come off of a downward trend. But as interest rates rise, qualifications become more difficult, payments rise, and you may not be able to buy a home because of higher interest rates. Sellers may be less willing to negotiate as the market begins to recover. So assuming that the market is recovering right now, it may be that sellers are less willing to offer credits for closing costs, less willing to entertain low offers when they come in, and that means you may or may not get that house based on those negotiations. Credit score. Your credit score can go down while you're waiting to purchase a home, whether it's too many inquiries on your credit report, maybe something has happened and you had a 30-day late and you didn't know about it, or an account becomes a collection. Or the lending guidelines just simply raise the credit score above what your credit score is, where you once could buy, you now can't buy. You also postpone receiving the tax benefits. That's where waiting can cost you. You could be taking a mortgage interest deduction and writing off your closing costs in your taxes, where right now you may not have any write-offs and you're paying more in taxes than is necessary. You're postponing those tax benefits. Certainly you're living in a home now, whether it's living at home with mom and dad, saving money, or renting an apartment or renting a house. You may not necessarily like where you're living, but you're just tolerating it long enough to buy something. The longer you wait, the more time you spend at a place you'd rather not be. And certainly last but not least is the first-time homebuyer tax credit. While that tax credit has now expired for most, it has not expired for all. Congress did extend the tax credit for 1 year to qualified service members, and most specifically, military personnel that have served more than 90 days overseas in service of their country. So that tax credit is still available to people that want to buy a home before April 30th, so long as you meet the qualified service member definition. Right now, I'd like to take a look at 2 examples of how waiting can cost you. And the first one we'll cover is how mortgage insurance has changed on an FHA loan recently. So we look at a $350,000 sales price with a 3.5% down payment, again using an FHA loan. You'll see that the mortgage insurance used to be 2.25%. The mortgage insurance upfront premium was 2.25% and has recently been reduced to 1%. And then the monthly mortgage insurance used to be 0.55%, has now been increased to 0.9%. So overall, you might think, well, this is a good thing. It's a big reduction on the upfront and a slight increase on the monthly. But let's take a look at the monthly payment. At 5%, you'd have an $1,853 payment on the old way and $1,831 the new way. That makes sense. You have a lower loan amount. However, with the increase in mortgage insurance on a monthly basis, the payment is $2,438 on the old way, $2,514 the new way, representing an increased payment of $76 from the old guidelines to the new guidelines. Now, if you're on the cusp because of debt ratios, you now don't qualify, or you may not qualify where before you did. Let's take a look at another example. It takes into consideration 2 things why people wait. Are 2 things that could happen. Let's look at a $350,000 example versus a $330,000 example. So somebody's decided to wait to catch the lower sales price if the market were in fact declining in value. We're using the same 3.5% down payment FHA loan, and we're using the same 1% upfront mortgage insurance premium, but the interest rate is increased from 5% to 6%. So you got the house for $20,000 less, but the rate's gone up 1%. The monthly payment has increased significantly on the lower priced house because of the interest rate, and the total payment overall has increased by $61. So you bought the house for $20,000 less, but you're paying $61 more per month. Waiting can cost you in a number of ways, and I've only covered 3 different ways that waiting can cost you. I just wanted to make this information available to you so you have something to help you decide when the right time for you is to buy. If you have any questions, please feel free to contact me at the information on this card. My mobile number, office number, and email address are right there for you. Hope you've benefited from the information. Thanks a lot.